Hey everyone, thanks for joining us. I'm here with Gio of Gojo Accountants, and Gio, thanks for taking the time to do this. I'd love to hear, a little bit about yourself and your firm.
Yeah, thanks, Angela. Really appreciate the time to be here. Really appreciate, your thoughtfulness in real estate from, financial planning standpoint and mixing that with investment strategies and just having really good, comprehensive understanding of how all of this works. I'm Gio Bartolotta. I'm a CPA. I've been in Gojo Accountants as a managing partner for over 5 years now. And real estate is one of my favorite topics, especially as it relates to income tax, estate tax. And what we have here is a presentation that outlines some of the broadly understood strategies, and we get into the details of how those work with respect to real estate, but then also maybe some new strategies that you haven't heard about before. So today we're going to be looking at income tax planning strategies. Angela and I will be discussing short-term rentals versus long-term rentals, what that actually means, what the real estate professional status can do for you. There's various areas of income tax efficiency. Obviously, you can benefit economically by reinvesting tax savings and tax deferral into the future, into new real estate properties. So really fantastic section of the tax code that we're going to talk about. And then furthermore to that, we're going to go into cost segregations, how they're used, why they're used, what types of properties they can be used for, and how they can be mixed with other strategies to maximize tax efficiency. We'll also go into 1031 like-kind exchanges. We'll clarify on any confusion with respect to what kinds of properties are eligible, what some of the rules are, and how they interplay with cost seg studies and other strategies. And finally, we'll look at S corporations and how they interplay with real estate. Commonly you wouldn't want to include real estate long-term rental holdings in S corporations, but we'll debunk that entire thought process later on in the presentation. This is where we are, short-term versus long-term. When we look at these types of properties, from a tax standpoint, essentially it's about the intent of the property. So for short-term rentals, you need to meet a quantitative statutory test of having an average stay of 30 days or less. When you do that, your property is depreciated over 39 years instead of 27 and a half, which is what you would see in residential properties. Even though the property might be residential, the short-term rental, it would still treat it as commercial, non-residential in the eyes of the IRS. That's because a short-term rental is treated somewhat like a hotel, a motel. It's almost like a hybrid between a rental property and an active trade or business.
So you bring up a good point there as far as how it's kind of treated like a hybrid. So when it comes to short-term rentals, what are some things that people will want to be aware of where, if they're providing too many services similar to a hotel, that really affects the tax treatment of the property?
Great question. So there's a fine line between what you're talking about, which is substantial services, providing substantial services beyond normal rental property management. Cleaning, basic furnishings, that wouldn't qualify as substantial services. So what happens is if you do perform substantial services, like you're performing, entertainment related services, chauffeur services, you're providing like event space or anything like that goes beyond just a traditional sort of hands-off rental property, short-term rental property, then in that case, your income is subject to self-employment tax. So it's 15.3% up to the Social Security income cap, and then anything beyond that would be subject to Medicare tax. And yeah, that's one thing that the IRS, they're always looking at, because the IRS would rather treat the short-term rental as just a Schedule C property because they'd be able to collect more in income tax and payroll tax. But yeah, that's something to keep in mind. But if you're just performing material participation services, like your standard management of like an Airbnb type property, or you're going on a recurring basis to do basic cleaning, basic lawn maintenance, that would not transcend into those substantial services. Rather, those would just be material participation hours that can factor in to treating that property as non-passive versus passive. So that's the fine line that you want to hit when taking advantage of this strategy.
That makes sense.
Jumping into the next strategy or this next characterization is long-term rentals. So any rental property that you have with an average stay of more than 30 days, that's when you're looking at treating them as long-term rentals. They're depreciated over 27 and a half years. And in order to deduct any ordinary losses and extract those from long-term rentals, reps is required, unlike short-term rentals loophole. So in this case, you would need to meet the two statutory tests, 750 material participation hours in a real estate property trade or business that you own, in addition to 50% of your total personal service hours. That would be material participation hours in a real property trade or business. There's 11 different types of real property trades or businesses that are designated by the IRS. So that's a great litmus test to look at to see whether the activities that you have and you own are eligible. And then assuming that you are eligible, you can then materially participate in that long-term rental, and there's 7 different material participation tests according to the 469 passive activity regs. Once you hit one of those, you can treat the property as non-passive. And something that's really interesting is a 469-9G election, which allows you to group long-term rentals. Let's say you have a portfolio of 10 long-term rentals all over the country. Maybe you have a couple of limited partnership interests in real estate syndicates. Assuming you meet the material participation requirements, you can group all of them as one. So materially participating at least 500 hours in those rentals, they're treated as one for the purposes of passive activity rules, and therefore you could deduct all of those rental losses against your ordinary income.
Obviously each short-term versus long-term has its benefits. I mean, I think that's pretty cool that with the short-term, there's that kind of loophole where you can use that depreciation to offset income. And I don't know if we're getting a little ahead of the slides here, but I mean, out of curiosity, would that also apply to your other active income that you're making? Like, let's say your day job is you're working in IT or something. The short-term depreciation also flow through onto that?
Exactly, precisely. And the standard and requirement in order to do so, to substantiate it, is much less stringent than the real estate professional status. So it's a common strategy where you'll see high W-2 earners, especially those with equity compensation, they're getting a windfall, financial economic windfall. And you can leverage that in the same year with the short-term rental, combine that with a cost segregation study to get that non-passive loss, and then match that up with your high ordinary income or even capital gain income that will offset and neutralize the tax impact there. So the next slide is we're going deeper into the real estate professional status. This is a key area of the code. What's interesting is we're kind of in the throes of some potential tax cuts, extensions, new tax reform. There's a lot going on in Washington right now, but it does look like 100% bonus depreciation is going to come back, will be retroactive to January 20th, 2025. And that is not just for properties. You have to essentially have acquired the property and placed it in service by January 20th, 2025 in order to be eligible for that 100% bonus depreciation. Not official, not law yet, but definitely something to think about. Obviously, the goal of this is to maximize ordinary losses, recharacterize rental losses, which are typically disallowed because they're passive, and recharacterize those as non-passive so you can deduct those losses against any form of income. And execution, I mentioned this a little bit briefly before, but you have to hit 2 statutory tests, 750 material participation hours in real property trades or businesses, in addition to 50% of your personal service hours. So all the hours that you're spent working and building businesses and doing work throughout the year, at least 50% of those hours have to be attributed to materially participating in those real estate activities. And then furthermore to that, having a contemporaneous log doesn't have to be anything crazy, but one that just shows, hey, these are the amount of hours that I spent working on this real estate activity, and this is what I did, this is where I was. And if you can do that and build a system that structures that, then that becomes the backbone for the rest of your life if you really want to get into real estate full-time. So once you have that figured out, you're good to go.
Well, what are some examples of jobs that would qualify? So obviously the big ones you always hear about are flippers or real estate agents. I know you said that there was 11 ones, so I don't expect you to list all of them, but I'm sure you got them all memorized though. But just a handful that people might be like, oh, hey, I didn't think that would possibly qualify.
Like I said, there's 11 and there's others. Essentially, you want to focus on what does the business do? What does the real property trader business do? So if you're in construction or redevelopment of tracts of land and property, that's a real property trader business. Like you said, if you own a real estate agent or you're a self-employed real estate agent, that would count because that's a business you own. That's a explicit real property trader business that you'd be conducting. Flipping as well, that counts. Can't depreciate flips though. So any property that's part of a flip, that inventory cannot be depreciated and wouldn't count for a 1031 exchange, but the activities count towards reps. And something that's interesting is that there are situations where, let's say, a real estate investor wants to start a real estate company, but they don't have the technical wherewithal or the knowledge or the specialty to identify properties. So let's say they build a company, a real estate management company, and they hire people who are actually experienced in specific areas. And let's say that person is a lawyer or that person is an accountant. A lawyer can do a ton for a real estate management company. An accountant can do a ton for a real estate management company. So there's creative ways where you can say, hey, I'm materially participating for the benefit of a real property trader business that carries out real estate management activities, and that counts towards reps, even though the underlying activity that you're performing isn't necessarily related to real estate. So there's some creative, levers that you can pull, and there are tax court cases that substantiate that. So that I find pretty interesting.
I mean, as you said, the business has to be in the real estate trade, so you would have to own a portion of the business. business. Now, is there a minimum percentage of the business that you have to own in order to possibly qualify for reps?
Yes. So typically, if it's a corporation, so if it's an S corporation or C corporation, you have to own at least 5% of the underlying business for it to be treated as one of your reps activities that would make you eligible. And then furthermore to that, let's say you're a limited partner in a real estate syndicate. If you wanted to essentially treat that real estate syndicate, the activity, the depreciation deductions that you receive that are allocated to you, you would have to meet 3 of the most stringent passive material participation rules, and there's 7 of them. So that's another area for limited partner owners.
And then one of the things I like you have here on the slide is the strategies, for spouses. Can you talk a little bit about strategy for a married couple where one might be in the real estate trades, the other isn't, and how the taxes can flow onto each other's return there?
Absolutely. So for, married filing jointly, taxpayer fact patterns that we've seen, it's common. You'll see maybe one spouse is a high earner, high W-2 earner. Maybe they're selling software. Maybe they're, a software engineer who's banked a lot of equity in a company, publicly traded company. You'll see that their spouse, maybe their employer might have a better health insurance policy, or maybe they're making like 20 or 30% of what their high earner spouse is making. The spouse, the non-working spouse or the lower earning spouse, is the real estate professional. So they're the ones that are meeting this test. They're the ones that are keeping the contemporaneous logs, and they have to own a percentage of the business. But both spouses can own 50% interest in their real estate business, and they'd be fine. They would meet the criteria. And then what can happen is once that non-working or lower earning spouse meets the real estate professional status criteria, the high earner might have more technical wherewithal or might be more plugged into the real estate investment world, or for whatever reason, they will be able to come in and actually provide material participation hours in joint with their spouse and combine those. So essentially, you're getting deductions for less work because of the overhead and combination that you have from working together. So that's something that we've seen that's massively successful and very, very common. So next area to segue into is cost segregation studies. This is an interesting topic. So cost segregation studies are essentially engineering studies that essentially help recharacterize property that's capitalized as Section 1250 property. So it'd be land or building, and that's depreciated over 39 years or 27 and a half years, and recharacterizing that as 1245 property. It's essentially depreciated faster. So that could be, anything in the house, and that would be, like furnishings, components, anything that builds up the property. So there'd be an allocation of the house that would be pushed towards that Section 1245 property, and then that could be depreciated at an accelerated rate, leveraging 168K bonus depreciation. So that's the big one. That's the same 100% bonus depreciation that I was referring to. It's currently 40% for 2025. And then you can also apply Section 179 expensing depending on the criteria. It's a lot harder to do that, but it is possible. But typically what you would do is you apply these studies to rental properties or investment properties or even business properties where you're carrying out ordinary trade or business and you own the real estate that houses that operating business. And you can leverage that using tax deferral. You can accelerate the depreciation, offset that against high W-2 income, capital gain income. Eventually, you can choose whether to use that cost seg study in a particular year. So let's say you place an asset in service in 2023 when there was 80% bonus depreciation, but you haven't even heard of the cost segregation study concept until 2025 when there's 40% bonus depreciation. Well, because you placed that asset in service in 2023, you get the benefit of 80% bonus depreciation in the year. Use the cost seg study and apply it as a change in accounting method on Form 3115 in 2025. And that's a very interesting tool because then you can match high income with the accelerated depreciation from the prior year.
Now, does it have like a similar deadline where you can go back 3 years to do that, like 3 years max to fix that? Oh, hey, I put the property in service in 2023, but if you have a property in service in 2020, then you wouldn't be able to go back that far?
Yeah, because the statute of limitations in collecting an income tax refund from the feds is 3 years, give or take. There are certain circumstances where maybe there was an amendment or a late tax that was paid in 2021 that could kick out that 3 years further from 2020. So it could go to 2024, 2025. But that's pretty much a case-by-case basis. But typically, yeah, you would be out of luck in that situation.
So I know people love cost segs because it's like, wow, I can wipe out all my taxes. But can you talk a little bit about like back end, what you have to be careful of, 1245 depreciation recapture, and even when doing a 1031 with a cost seg property, what some of the extra steps are that would have to be done?
So like you said, when you have a cost seg, you're essentially sitting on a potential income tax bomb because you've accelerated depreciation beyond the normal straight line mechanism that's usually in place for most of the property. So when that occurs, if you sell, you have to pay ordinary income tax on any depreciation recapture that's on the 1245 property. And then anything that's related to 1250 is technically a capital gain tax at a hybrid max rate of 25%. You can defer that out further by doing a 1031 exchange, and just 1031 where that's a like kind exchange for land or other buildings into other land and other buildings. All right. So you do that and you can defer tax with some caveats. As Angelo was saying, there are situations where you could potentially recognize income tax upon not essentially acquiring replacement property that has sufficient basis that doesn't exceed the 1245 basis from the relinquished property, the one that you sold. Same goes for the 1250 property, etc. So you need to take a keen eye to making sure that the transaction is completely tax deferred, especially when you've run a cost seg on a property previously. And then also you'll definitely want to run a cost seg on the replacement property to make sure you can match up the basis accordingly, because you'll have all this new 1245 basis that you have to account for.
One last question on this slide. Are there any other benefits to doing a cost seg other than accelerated depreciation?
Yes. So besides, like you said, accelerated depreciation, there are situations where you'll usually see this for higher value properties when there's furnishings or major components or major structural elements to a building that need to be replaced, like a roof, $50,000, $100,000 in certain cases. What will happen is with the cost seg, it will identify that roof. It will identify that large structural component and assign an adjusted basis to it, right? And so what happens is that when you replace that structural component, most of the time, most people just ignore it and it just stays in the basis and gets depreciated over a certain period of time. But by doing this, you're actually accelerating disposition, because instead of waiting to sell the property to leverage that basis against the proceeds upon selling the property, you can actually accelerate that basis and deduct it in the current year. It would be treated as a passive deduction if you didn't have reps or it wasn't a short-term rental with the short-term rental loophole. But assuming you were a material participant and it was non-passive, then it becomes another non-passive deduction against your positive or ordinary income.
Quick question as far as that deduction. So you're saying you can deduct 100% of it in that first year?
Yeah, the vast majority of it, because there's no proceeds. You're replacing a roof and then you're deducting the old roof that was essentially removed to make room for the new roof.
Okay, so then that falls under the 179 expensing then?
No,
Okay.
it's called a partial asset disposition, and it's an election you make, and it gets reported on Form 4797 as like a sale of business property, but it would just be sale of business property at a loss, and that's actually known as a Section 1231 loss, which is an ordinary loss for businesses. One other strategy I want to talk about actually before we move on that I find pretty interesting is, let's say we've talked about cost segregation studies with respect to reps and the short-term rental loophole that requires material participation. But let's say you were just a high W-2 earner, you didn't get involved in any of these strategies, but you're still a big-time real estate investor. You can still run a cost segregation study on passive real estate rental holdings. What will happen is it will actually generate a large passive activity loss, suspended passive activity loss. So let's say, I buy a long-term rental for $500,000. For the sake of argument, let's just say it's 40% bonus depreciation. I run the cost seg, and after everything, my depreciation deductions from that cost seg for 2025 is $50,000. So $50,000 goes against the gross rental income, etc., right? But let's say I wasn't a material participant. That $50,000 in losses becomes a suspended passive activity loss. What I can then do 2026 is I can go to the market. I can either start a business or I could find an interest in a business, whether it's an S-Corp or a partnership or a real estate syndicate, and I can identify a business that has positive taxable income, perhaps a business that's already exhausted all of its depreciation or the vast majority of its depreciation. I can purchase an interest in that business, and then I would generate passive activity income from those businesses, and then I can match them together with the suspended passive activity loss carryover from the previous year, and voila, you have tax-free income in 2026.
That's funny you mention that, because that's actually what I did a few years ago, where I purchased a position in my family's property management company, but it's a passive business activity. So the excess depreciation from my rental was able to offset a lot of the income from that.
That's awesome. I love seeing that magic happen in real time.
Yeah, no, tax strategies are key.
All right, cool. On to the next slide. A 1031 like-kind exchange is your ability to defer income tax, which is recognizing income tax. You're still going to realize a capital gain or loss on any property you sell, and you're going to work with a qualified intermediary. And what's going to happen is you just need to essentially identify property that was used or is intended to be used in a trader business or in an investment capacity, and the property that you're selling had to have been used in a trader business or an investment capacity. And typically you want at least 2-year holding periods with both both property that you're selling and that you're 1031ing as well as holding it for 2 years. So the key difference here is realized gain is the economic benefit that you have from selling the property. You have this realized gain, but using a 1031 exchange allows you to defer the recognition of that gain for income tax purposes.
Can you define like kind? Because I actually had a conversation with a client a few weeks ago where this trips up some people as far as what like kind means. So let's say if you do a 1031 on a residential property, does that mean that you have to 1031 into another residential property?
No, you have to 1031 into something that constitutes either building or land. So that's the primary objective. You could 1031 from residential property into a campground, in theory, campground property. You could 1031 to vacant land. You can 1031 from your investment property into multiple properties, depending on other rules and complex regulations related to doing this. But there are ways to do this in a very creative way. It's not limited, but the only limitation is that it's for real property, so land or buildings.
And then let's say if you were to 1030, like the typical thing is, oh, you do a 1031, you want to just buy a property that's more valuable. But let's say you sell off a property for $1 million and you buy with a structure on it, and you buy a piece of just raw land worth $1.5 million on it. Now, a lot of people would think that, oh, okay, cool, 1031 done, I can defer my taxes. But you talk a little bit about the taxation of that and how, no, that's actually not the case.
Yes, exactly. So it all comes down to the characterization of the property and how much depreciation has been taken, et cetera, right? So let's say you did rent a CASA, got a property, an investment rental property that you owned, and you did perform a 1031 exchange into land, as you said. In that case, the 1250 element of it could be neutralized, the land and building element, because you have land, part of the property that you're relinquishing, but not all of it is going to be attributed to land. A lot of it will be attributed to tangible personal property, Section 1245 property, and land doesn't have any Section 1245 property because there's nothing tangible on it other than just the earth or anything or minerals or anything underneath it. You know, for the most part, like there would be nothing there to defer and to have in a like kind capacity. So it's key to essentially take with a magnifying glass and looking, okay, what is the property that we're selling? What is the composition from a tax standpoint? What is the basis and fair market value of these different buckets? And then you have to look at the new replacement property and see if it matches up at least with that, so that you don't recognize any taxable boot, which is the major pitfall to these 1031 like kind exchanges.
Final thing on the 1031s, let's say that you're a landlord who's just, sick and tired of dealing with the tenants, toilets, and termites, but you realize, hey, if you sell, my cost basis is so low because I've just been 1031 and nonstop. Let's look at like Delaware statutory trusts. Can you talk a little bit about those and how that might be a really good option for those landlords?
Yeah. So the IRS issued a revenue procedure years ago that pretty much gave Delaware statutory trusts, essentially they're treated as real property. So they fall under the 1031 like kind exchange umbrella, because even though you're purchasing a beneficial interest in a irrevocable trust, the trust is essentially melded and built into real estate property, right? So the underlying trust instrument is really built around, okay, this trust is just all these like different interests, beneficial interests in that real estate property. So that could be a massive apartment building, it could be commercial property, it could be anything. But by selling your investment property, your rental property, and then, doing a 1031 exchange into that beneficial interest in the trust, you're getting exposure into real estate without having to deal with the actual maintenance, the getting your hands dirty. It gives you that exposure, maybe an 8 to 10% annual return on investment, which is maybe not as much as real estate investors are looking for. But when you get to a certain age and you're still looking to defer taxes, it's a great solution for a lot of people.
Yeah, so similar stock market returns, but with less volatility typically. So,
and tax efficiency, because you didn't have to pay tax. So yeah, effectively maybe like 15%.
Yeah, exactly. And then on top of that, the any of the excess depreciation that would flow through your tax return from these DSTs, right?
Yes, I believe you would just get a payout each year and in the form of a K1, and that's how it would work going forward. Coming down to the end here of the presentation, S corporations and real estate properties typically wouldn't go hand in hand for our clients. We would usually, steer them away, saying, we get the question all the time, what tax entity structure should we create for our new real estate rental business? More often than not, you would want to include that in a single member LLC, or if you have partners, a partnership, a multi-member LLC. The reason for that being is because what happens is if you contribute appreciated property into an S corporation or C corporation, extracting that property, it becomes a taxable transaction, even if you distribute it to the owners of the corporation. So it's treated as an asset that is owned by the corporation, which is separate from you. So taking that asset out without triggering income tax can be quite difficult. So that's why we want to avoid that situation in the first place. But that being said, there are a couple of situations in the real estate investment world where they apply. First one is sort of not something we would recommend a lot, but it's something that's interesting and I think could be very beneficial for the right person, right taxpayer. And that's converting a primary residence for which it would be eligible for the Section 121 exclusion and converting that into a long-term rental. The ultimate goal is to take advantage of that Section 121 exclusion, which allows you to exclude $500,000 in the case of a joint filer. What happens in this situation is you can, let's say your house appreciated, you lived in it for at least 2 years in the last 5 years, you owned and lived in it, and it appreciated $200,000, you bought it for $300,000. You can sell it and you would be able to exclude $200,000 in federal capital gains and state income tax for the most part. Most states conform to federal Section 121. So by doing that, you can actually sell the property to an S corporation that you own. It's a related party transaction. The capital gains are excluded, and essentially you would issue a note from yourself to the S corporation, and then you would pay back yourself from the S corporation over time for the purchase price of the home, and then you would get a step up in basis because of that purchase price, and you'd be able to deduct depreciation deductions there. You'd be able to potentially combine a cost seg study there and allow you to offset more ordinary income. Pretty interesting but complex strategy.
Can you talk about like how, as far as another strategy with your primary residence, kind of combining the Section 121 with the 1031, some of the benefits of that if you want to keep scaling your rentals?
Yeah. So in situations, let's say you lived in a primary residence and you owned it and lived in it for 2 years out of a 5-year period, you wanted to convert that to a rental property, and you can do that for up to 3 years without losing the Section 121 exclusion. So in theory, you could sell that at the end of a 5-year period in which you owned and lived in the house for the first 2 years, and then rent it out for the next 3, and then sell it, and you'd be able to take advantage of that full $500,000, assuming you're filing jointly, exclusion, and then any depreciation recapture on that would have to be taxed when it's sold. You can avoid that. But you could do a 1031 exchange to defer the income tax recognition on that depreciation recapture. Let's say you rented it out and you sold it for far beyond the Section 121 exclusion. You could combine the Section 121 exclusion, get the full amount, and then 1031 the depreciation recapture and any of the other appreciation going forward into a new property. So there's a lot of different things you can do with both of those income tax provisions.
I think it's fair to say the tax code really benefits real estate investors.
For sure, like by far. And it's been that way for a long time. They tried to make it harder in 1986 with the Reagan years, but there's still so many benefits, and it doesn't appear that they're going away.
Now talking about like management companies, so this other strategy, this is something that's really interesting strategy. I'd love to hear more about.
Sure, yeah. This is the other S corporation real estate related strategy. Let's say you're a real estate investor, you have a portfolio, you're accumulating rental properties. You would want to make sure that those properties are either owned in your name, or better yet, they're owned in an LLC's name that you own, or maybe you own with other partners, and that would be taxed as partnership in that case. And then separately, what you would do is you would set up a management company, because what happens is with real estate rental income, like after you get through all the depreciation deductions, you get through all of the losses, eventually you will become income positive from a tax standpoint. Though that income is it's not earned income in the eyes of the IRS. So you can't contribute to retirement accounts. You can't contribute to an IRA leveraging positive rental income, even if you're reps. You wouldn't be able to contribute to a 401k, a SEP. So all these different things you wouldn't be able to do. So by setting up an S corporation management company, you would have to pay yourself a reasonable compensation. So you'd have to pay yourself a salary, and the salary in the form of W-2 is earned income. So then you'd be able to essentially, the rental properties would essentially pay a management fee to the management company that you own, and you'd be shifting over rental income that would not be earned to earned income that would allow you to then deduct any self-employed health insurance premiums if you need to cover yourself, in addition to any retirement contributions you want to make.
Gio, thank you so much for joining today and just going over all of this. I mean, there's a ton of tax strategies here, very actionable tax strategies that a lot of real estate investors would find super beneficial. So I'm sure that there's a lot of people out there who are wondering like, hey, how can I get in touch with Gio?
Yeah, absolutely. Thank you for the time, Angela. This is great. Thank you for the great questions and for just the opportunity to just talk about real estate with you, real estate tax. And if anyone wants to contact me, reach out, talk about real estate tax or just anything at all, needs help, you can reach me at gojoaccountants.com. We have a consultation request form, so you can just fill in your information there, and then we'd reach out to you shortly and get the ball rolling.
All right, great. Thank you again, Gio.
Thanks, Angela. Talk soon. Bye.
Bye.